Okay. Okay. And so the third thing I'd say is that if it will be more valuable if it is interactive, which means that as I'm talking, if you ask questions, make observation, that just will make it more valuable. I don't think that's what you intended is. I don't want this to be a monologue because it can be extremely boring. And so I urge you that along the way, if you feel that you need to make some observation, comment, please feel or ask a question. Please feel free to do that. So with those points, let me start. Now, I start with how we see at the role of financial system in any economy, taking the broadest possible view. What does the financial system do? So the fundamental role of financial system is to convert savings into capital. Whether it's banks, whether it's insurance companies, whether it's mutual fund, their fundamental role is to take savings from people or firms, and then convert it into investable capital, either equity capital or debt capital. That's the fundamental role of the financial system, right? In any economy, not just India, anywhere in the world. And this conversion is achieved through the mechanism of the financial systems, which are and the financial system consists of two main types, two main parts. One are financial institutions like banks, NBFC, insurance companies, so on, and then financial markets, the equity market, the debt market, the derivatives market. So there are either institutions or markets. And so the entire composition of the financial sector in any country can be broken up into these two types. What are the financial institutions? What are the markets? And they interact with each other in the sense that institutions participate in the markets and so on and so forth. Now, whether it's institutions or markets, when they convert savings into capital, households or firm savings into capital, they achieve through there are three transformations that take place. In other words, when a household gives his or its money to a bank or to a mutual fund, and it gets invested as capital into some other entity in a business, it undergoes three types of transformations. The first is maturity transformation. You might give a 1-year deposit, the bank may make a 3-year loan. So you have actually changed the maturity of the amount that has come in, right? Ulta can happen. You can give a 3-year deposit, the entity can make a 1-year loan. So the maturity of the savings is not the same as the maturity of the capital that gets created, right? So that's the first transformation. The reason I mention this is I'll link it to risks, where risks arise in the financial. So first transformation that takes place is that of maturity of the savings or the capital that gets converted, that the savings get converted into. The second is risk transformation. What do I mean by that? When you make a deposit in a bank, you are reasonably almost 100% sure in India that you will never lose money. In the history of Indian banking, bank depositors have really never lost money. They may have got money late when the banks went into trouble, but they never really lost money because of deposit insurance and many other institutional features. However, so essentially a bank is taking a risk-free money essentially from the savers, but making risky loans, because the loans that the bank makes are not risk-free. As we saw through the entire NPA episode, there are a large number of borrowers who defaulted, which continue to default. And so essentially you are taking risk-free money. You are assuring the savers that their money is essentially risk-free, but you are making very risky loans from them, or reasonably risky loans from them. This is the risk transformation. So there's a maturity transformation. There is a credit risk transformation, you can call it. That from near riskless deposits, you are making risky loans. Right? That's the second transformation. And the third transformation you do is what is called lot size transformation. We make 10,000 rupees deposits, many of us, banks make 1,000 crore loan. So it has taken small lots and converted into a much larger credit. Similarly, a mutual fund can take 1,000 rupees from 10,000 people and buy shares worth 100 crore for somebody. So that's also lot size transformation. So the financial system undertakes these transformations. This is the way it operates, not just in India, anywhere in the world, right? Which means these three things are essential characteristics of a financial system. Financial system cannot exist without this. And all these three create risks. That is why risk management becomes so important. And here it is important to understand that financial businesses are very different from non-financial businesses. This doesn't happen in cement business. Somebody running a cement company or a steel company faces risks, but not as an intrinsic part of the business. It comes because of price volatility in this and that, some operational risk, like something may break or some fire catch may fire, something may catch fire. But the very nature of the business is not risk. Whereas in case of banking and financial services, the intrinsic nature of the business creates risks. And that's why risk management becomes so fundamental to managing financial services businesses, right? And this is also to therefore managing these risks, the risks that arise out of these three transformation, maturity transformation, risk, credit risk transformation, and lot size, is the essential fundamental role of financial risk management in financial services. Is, by the way, also becomes the basis of regulation. If you look at banking regulation, or if you look at other financial services regulation, a lot of that, a majority of that is oriented towards containing risks that arise out of these three things, arise out of this transformation, right? So this becomes the basis of regulation as well, not entire regulation, but a predominant part of the regulation. And then the regulators use multiple tools to actually contain these risks. And I'll talk a little bit more about regulation. So both the management of the companies as well as the regulator, both are trying to achieve the same objective in some sense, is to contain risks that arise out of the intrinsic nature of the business of banking and financial services. Now, obviously, not all institutions conduct these transformations to the same extent. So, for example, a bank is very different from a mutual fund. Mutual fund is a risk pass-through vehicle, which means whatever risk they undertake in their investment is passed through the investor. So they are not doing any risk transformation. They are doing lot size transformation, a little bit of maturity transformation. Whereas the bank is also doing risk transformation. So therefore, different institutions, insurance is doing a different kind of transformation. So different institutions do these transformations to different extent, to different level. And as a result, their risk exposure becomes different. And as a result, the risk management in, let's say, bank is quite different from that in an insurance company. It's quite different from that in a mutual fund or a AIF, alternative investment fund, etc., etc. So while broadly they are all doing these things, the extent to which they can carry out these transformation varies across them. And as a result, the nature of risk management changes across these institutions. Now, if you take a more longer term view, let's say we talk about Viksit Bharat of 2047, etc., etc., and then we start asking ourselves the question, which I often ask myself, do we have a financial system ready for that? India will probably become a 10 to $15 trillion economy. Do we have a financial system ready to support that kind of economy? Now, how do I answer that question? So my view is that you answer that question not by defining how many banks you need or how many mutual funds you need or how many insurance companies you answer that question by saying, what kind of qualities I want to see in that financial system so that it supports that size of an economy. And to my mind, 5 important qualities are essential, right? The first one is just capacity of the system. Remember, we started by saying that the role of financial system is to convert savings into capital. Now, as you become large economy, you need larger amount of capital, right? So the system has to have capacity to mobilize that much of savings, whether it's domestic or international, global. Eventually, I think we'll have to become global, more global. So the system, financial system has to have the capacity to ever increasing amounts of savings into capital. So you have to build that capacity. So how do you build capacity in banks and insurance companies and mutual fund to mobilize larger and larger quantities of capital? I mean, let's say today we are moving roughly about 12 trillion or so, 12 lakh crores of incremental credit every year across bond markets, banks, etc. That order, 12 to 15. Last year was a bit higher. I mean, that number will become 40. So do we have the ability to create incremental credit of 40 lakh crore every year? That's the capacity question. So the first quality you need in a financial system as our economy grows is to have larger capacity. Now, with larger capacity means larger risk, because if you are doing larger amount of transformation of saving, then obviously you're exposed to larger amount of risk. Secondly, you need efficiency. There is a cost of this transformation. The average cost to asset of Indian banking is 2%, which means if you take a deposit at 7%, if the bank has to cover its cost fully, it can only lend it at 9%, because its own cost of operation is 2%. India is one of the highest cost banking system in the world. This 2% in advanced economies is like around less than 1%. So we are very inefficient, despite the fact that we have become quite big. So as you become bigger and larger, you also have to become more efficient, which means this cost will have to come down. Now that also creates kind of risk. You'll deploy more technology that creates operational risks and so on and so forth. So even improving efficiency on the other side creates risks and costs.
Technology also has a cost which has to be built up.
It has to be built up, but with the assumption that it will save other costs. But then it exposes you to risk that arise from technology, right? Third, you need resilience. What does resilience mean? Resilience means that if there are fluctuations in the economy which are inevitable, GDP grows, it comes down, it shrinks. Now we are saying there might be recession. The system should remain stable. And throughout our history, we have seen episodes of ups and downs in the system, the NPA cycle and all of that. That's not good, because the moment system goes into an impaired state, when the banking system shuts down, the whole economy goes down with it. Because supply of credit is like supply of oxygen to a body. If you cut down credit, the whole economy kind of drags. And so what we need to create is a resilient banking system, which is not only large and efficient, but also resilient, which means it can withstand the cycles in the economy. Okay, now that fundamentally means that banks manage, or institutions manage, risks better, because the way you become resilient is by better managing risks. All the episodes of NPAs and all kind of signal that we didn't manage our risks well. So that cannot happen in future.
RBI does this stress test.
Yeah, it does the stress test. True. That's aimed towards understanding the system's resilience. That under worst case scenario, what will happen to the banking system and so on. Correct. The fourth point is access. We still do not have, there are large segments of our business in our society which does not have full access, which do not have full access to the banking system, to the financial system as a whole. Obviously, we talk about financial inclusion and so on, with people at the bottom of the pyramid don't really have as good an access as they should. But it's true of even business. A lot of SMEs don't get credit. I've known people who have been in business for 30, 40 years, do not get a penny of bank credit unless they put up a collateral. Now, that's a sign of a system without enough access. Why should that have? Somebody in business for 40 years should be able to get some loan without collateral, but there are many, many businesses where that's the case. So we have to improve access as we become bigger and more developed. The system has to improve access. Now, again, as you improve access, newer risks come, because you are serving different segments with different products, and all of them expose the system to newer risks. Recently, you would have seen that there has been a bit of a turmoil in the microfinance business, right? Last couple of quarters. Now, microfinance is serving a particular segment of this economy, which nobody else serves. But they are now going through a bit of a bad patch. The loans are shrinking. The total loan outstanding has actually come down quite significantly. They are going to an NPA situation and so on. So that just shows you that when you create access for segments that are historically lacked access, you create new kinds of risks which have to be managed. And finally, you have to become innovative, because as your real economy becomes more complex, your financing systems have to become more complex and more innovative. So for example, if electric vehicles become more dominant, then how do I finance electric vehicle? Today, a NBFC or bank knows how to finance a petrol car, because they have studied for the last 25, 30 years, what's the life cycle of a car, what is the economics, how much can I lend, etc., etc. Now, do you have to do that for electric vehicle? None of this is known because it's so new, right? So, as the real economy becomes more innovative, more complex, more global, so does the financial system. Now, again, that exposes you to new kind of risks. And so, not only today as system as it is, but even if you look into the future, you can realize that the system will get continuously exposed to newer kind of risks, which will have to be managed. And therefore, risk management remains a very core function of banking. In fact, I always say that managing a bank is managing risks. Everything else is effectively secondary. Or managing a insurance company is essentially managing risks of a different kind. So that is how fundamental risk management is to the functioning of financial system. Okay, so you will see these. I mean, this is essentially a summary of what I am going to present. These kind of themes running through my presentation. Okay. Before I move on, let me just. This is kind of my mental image. I told you I'm not an accountant. I think like a part engineer, part economist. So this is my sort of mental map of how financial system works. So what you essentially have, we have savers, which are providers of capital, and then you have users, we are users of capital. Now, savers can be households or firms, and the users can be households or firms. In between, you have either financial institutions or financial markets, right? So I told you their role is to take money from the savers and give it to the users of capital. This is how the financial system works. The most common institution you know is a bank, right? But you also have insurance, you also have pension funds, you also have mutual funds, you will have also alternative credit funds, right? These are the most important. There are others minor ones, but these are the most important financial institutions. All of them form a part of what I call the financial institutions group, right? And then your market, your equity markets and debt market. Primarily, you can also add derivatives market, but they just ride on the underlying equity or debt market. So this is really the composition of the financial system. So when I talk about risk management, I really talk about the top, which is the risk management in institutions. Market risk management is slightly different area, and which probably I'll not touch upon so much today. Now, how does this work? So banks take money from savers in the form of deposit. We are all depositors. Insurance companies take in form of premium. Pension fund, mutual fund, all take in form of investment. We make investment in mutual fund, we make investment in pension fund. So the forms vary. Now, why is that important? Because a deposit, when you make a deposit in a bank, the bank makes you a promise. The promise is that you will get your money back. The promise is not similar to promise in case of insurance. In insurance, it makes the promises somewhere to happen, life insurance, somewhere to happen to somebody else will get money. It's a different kind of promise, therefore a different kind of risk. Whereas in case of mutual fund, you make investment and you take the risk. So you trust the skill of the fund manager saying, I know you are good, you will make good investments. So across this institution, the nature of risks borne by the investors is quite different. And therefore the nature of risk management in these institutions becomes very different, right? So that's the reason this point is important. And then in markets, you directly buy or sell securities, right? Basically, that's how you participate in the capital markets. Now, on the other side, what happens? Banks can give households loans. We take home loans, car loans and all. They can even give firm loans. But in between, there can also be an NBFC. Banks can give money to an NBFC, which that NBFC can make loan, right? NBFC can also raise money from the bond markets. Upendraji knows this very well, that you can either issue bonds or you can take bank loans, right? So all these institutions, sorry, I'm going to speed up a bit, can actually access institutions which are going to give them loans, or they can issue securities. They can issue shares, they can issue bonds, and they can access bond markets or stock market, right? That's the way savings from the savers become investable capital into firms or even households. In fact, the third thing I would have added is government. The big borrower is government. So banks borrow government, banks buy government bonds. They are mandated to buy government bonds. So even the government is a big borrower. In fact, among the bigger borrowers in India. And so this whole complex map, money is raised to by firms from the markets and some kind of investment by issuance of securities, not by taking loans, right? No funds can make loans, right? So this picture in a nutshell summarizes how the financial transformation happens and where it creates risks. So you can understand there are risks that is get created on the side of the investor and risks that get created on the side of the borrowers. Now, the reason these boxes are color coded differently because there are different regulators. All the cream one are RBI, regulated by RBI, green one by insurance, IRDA, the PFRDA regulates pension fund, and everything else is SEBI. Now, debt market, I have colored both because part of the debt market is regulated by RBI, part of the debt market is regulated by SEBI. It's a complicated problem. The government securities market is regulated by RBI. Corporate bonds are regulated by SEBI. Money market is regulated by the RBI. So in a nutshell, there is this complex machine called the financial system, which converts savings into capital, and elements of it are regulated by different regulators. Now, instantly it should tell you that the regulators need to have some amount of harmony between them in terms of how they look at risk and how they manage. That's not often the case. So you often find that exactly same kind of issue is regulated very differently from by RBI than by SEBI and so on and so on. That happens quite often. Now I said that remember three types of transformation: maturity transformation, risk transformation, and lot size transformation. Now different entities do that to different levels. For example, banks do all three. Banks do maturity transformation, they do risk transformation, do lot size. So do insurance companies. Insurance companies also do all kinds. That's why for them, risk management is the most important, because for them, it is a very complicated affair. Compare that to mutual fund. Mutual fund is not doing risk transformation. It's a risk pass-through, meaning the risk in the mutual fund investment is given to the investor. But they do maturity transformation, they do lot size transformation. If you look at alternative investment funds, they don't do maturity transformation. It's a closed-ended fund. You invest, you only get your money back when you get your money back. But they do lot size transformation. They take 50 lakhs, 1 crore and make investments of 100, 200 crore. Point about this is that, and markets, by the way, do none of this. Markets do no transformation. You buy 100 rupees of shares, you get 100 rupees. Nobody's aggregating. If you take all the risk that you take on the shares and the bonds that you buy. So markets, therefore, there is no mechanism in the market other than the participant themselves managing their risk. There is no other institution that comes into play. Whereas in financial institutions, they have to manage the risk. And that's why they have risk management function, they have risk management processes and so on and so forth. Okay? So this is the reason I mentioned earlier that while we say financial system almost as if it's a monolith, it is not. Different components of it behave very differently when it comes to risk management. Now I'll just quickly, what's the time? Okay. So I'll focus on banks because, as I said, banks and insurance are the two entities where risk management matters the most. And so what is the essentials of a banking model? One, it is deposit taking. The unique thing that separates banks from everybody else is their ability to take public deposits. No other entity in most jurisdictions is allowed to take public deposits. In India, there are a handful of NBFCs which came into being long time ago, which can take term deposit, fixed deposit, but savings account nobody can open. And even NBFCs, RBI has stopped giving deposit taking licenses. There was a time until in the old companies law where companies could take deposits. Even that has been stopped after the 2013 version of the companies law. So the singular thing that separates banks from any other institution is their ability to take public, their ability to directly access household savings. This is a unique privilege that no other business has. No other business can take money in debt form from households. Only banks can. Then there is this supremely important concept of solvency and liquidity. And I'll cover that. Basically, banks face two main, all the risks that banks face convert into these two types of problems. Banks can have either a solvency problem or a liquidity problem. And I'll give examples of both, right? And the risk universe of the bank composes of three main types of risks. You might see people showing you charts with 160 risks. That's nonsense. There are only three main buckets of risk: credit risk, market risk, and operational risk. Every other risk that somebody can describe can be put into one of these three buckets. And therefore, the entire risk management setup is oriented toward these three types of risks. I will not get into this. This is a more economic issue. I teach a class at an economics postgraduate course. So that's why banks are the only institution that can create money. This whole role of money creation that bank can create money out of thin air, which is a privilege of bank. And that also creates a set of problems. I'll not touch upon them today. The very important idea in the banking system is the notion of connectedness. Banking system is highly interconnected. Banks are connected with each other in a very complicated way. This doesn't happen in any other business. This doesn't even happen in insurance. No, so if one bank goes down, it can take 7 banks with it, which has happened in the global financial crisis in the world. This doesn't happen in cement. If one cement company goes down, it's not going to take 7 cement companies with it. So this connectedness of banking creates what is called systemic risk. And that is why regulators are so worried that it's never an issue of just one bank. So if one IndusInd bank has a problem, the worry is not that one bank is in problem, that it could transmit to other banks, because the banks are very highly interconnected with each other. They have large number of transactions with each other and so on and so forth. So this interconnectedness is a very unique feature of banks. And there are finally regulation. And as a result, in most jurisdictions in the world, banking is highly regulated. In fact, outside of nuclear power and pharmaceuticals, probably this is the third most regulated sector in any country. Because of some of these risks, because of the systemic nature of the risk and so on and so forth. So systemic risk management through macro and micro prudential regulation, as RBI will call it, is an important role of regulation. Then there is this notion, again, I'll not get into fractional reserve system, which is that part of your deposit you have to put at reserves in the banks, the so-called CRR and SLR into terms you would have heard. That's called the fractional reserve system. It's an economic concept. There is risk capital, which I'll talk about, which is that one of the main instrument of managing risk is asking for capital, owner's skin in the game, which kind of provides a buffer to the risks that the bank takes. Okay. The concept of liquidity ratios and managing liquidity, as I said, risk capital is primarily oriented towards solvency problems. Liquidity ratios and liquidity risk management is oriented towards the liquidity problems. So therefore, both of them have to be managed through regulation. And then there are operational risk related regulations in terms of what the banks can and cannot do, how they should do their business, etc., etc. Okay. So with that background, any question, comments? Otherwise, I'll move to more technical issues. So solvency and liquidity is very fundamental to understanding risks in banking, right? What is solvency? Sorry, liquidity crisis means that the bank or a financial institution unable to meet its obligation. What it means is that tomorrow a depositor shows up in the branch, wants to withdraw her deposit, cannot get it because bank doesn't have money. It doesn't mean that bank is bankrupt. The bank may be completely profitable, but this could still happen. In the global financial crisis, there was a bank called Northern Rock in the UK, which failed. It was a completely profitable solvent bank. It failed because of liquidity, because depositors showed up and there was no money to give back. So liquidity crisis is a crisis when institution cannot meet its obligation for the next 1 week, one next day, and so on and so forth, which can happen without there being a solvency issue. So despite the underlying model being profitable and solvent, and why does this happen now? If you are an institution which cannot meet your obligations, what is your choice? Your choice is to short-term raise money from somebody. I am solvent, I have valuable assets against them, please give me money so that I can pay somebody. When that short-term funding freezes is when you hit liquidity problem. And this happens because you can't liquidate your assets. Now imagine, I'm taking IndusInd because it's recent memory. After whatever happened to them, there was a flight of deposits. So they had to suddenly raise 16,000 crores of CDs. If they had not been able to raise it, they would have to start selling their loans or selling their bonds. Now there is no market for that. So they may have had to sell it at a deep discount and so on. So that's the reason liquidity and access to short-term liquidity becomes very important. That's the reason RBI runs a liquidity window. The so-called repo window at RBI, or LAF as they call liquidity adjustment facility, is meant towards solving these problems. So if there is a bank that has liquidity requirements, it has collateral, which means government securities, then RBI will give you short-term money so that you can tide over this liquidity problem.
So the risk in this case,
Ha.
IndusInd Bank,
Hmm.
in the current scenario,
Hmm.
the bank was able to even garner 16,000 crores of CD.
With RBI's help.
That's because of the user group backing the.
No, it was because of RBI. RBI nudged private public sector bank to buy their CDs. Banks never buy each other's CDs. It makes no sense. 8,000 of that 16,000 was bought by State Bank of India. So basically RBI orchestrated a support from other banks to the bank. It was not because of Hinduja backing or anything.
The risk element when you have a backing of such a big group is also considered by investors.
Well, it's considered more from a solvency view because the idea being that this group will put capital. Capital doesn't solve liquidity problems. So that's where you have to separate a solvency problem from a liquidity problem. Liquidity problem cannot be solved no matter who's the promoter. You have to infuse short-term liquidity. I always liken it like surgical strike. Liquidity infusion is like surgical strike. For a short period of time, you have to give liquidity and then you can take it back because then the problem is over, right? Solvency crisis implies erosion of capital base. So which means that bank basically goes bankrupt, which means that you make so much losses that your capital base is eroded. And that can happen even when you are not in a liquidity problem. If you went back to 1990s, when the banking reforms happened, for a period of 3-4 years, some public sector banks had negative net worth, but they had happy deposit growth. People didn't care because it was government banks. So there was almost like an implicit government guarantee, which means the banks were completely insolvent. They were bankrupt and yet had no liquidity problem. So both can happen. You can have solvency problem without liquidity and you can have liquidity problem without solvency problem. That's why they have to be. Now, obviously, if you have prolonged period of liquidity, it will turn into solvency because you'll have to do asset sales and that will have losses and so on and so forth. But by their nature, they can arise independent of each other. And they require very different solutions to deal with them. So solvency problem requires capital infusion. Somebody has to put in equity capital. Now remember, when take the Yes Bank case, stock went from whatever 260 rupees to 7 rupees. Who will put capital at that level when the stock has fallen? So that's also that time RBI had to orchestrate other banks and get them capital. So they solved a solvency problem that time. With IndusInd Bank, they solved a liquidity problem using their power of persuasion with other banks and so on.
Because deposits were moving on.
Well, that's so. If it goes out in the public that the bank has solvency problem, then there will be flight of deposit. So solvency problem will turn into a liquidity problem. But I'm saying they can come into being. This problem can arise completely independent of each other. Okay. And so this problem is that the capital gets eroded and the bank cannot raise capital in short term. So then the bank essentially becomes bankrupt. This is what happened to DHFL. This is what happened to ILFS and so on. Basically, they run into solvency issues. They had no liquidity issue because they had no depositors. They were all banks which are given money. So banks were not suddenly calling their loans back. They just had so many losses that are not provided for that they essentially became bankrupt. Solvency problem will lead eventually to liquidity, and liquidity problem may arise completely for solvent bank. I just mentioned that. Addressing liquidity and solvency problem require different interventions. Liquidity risk requires, as I said, short-term access to liquidity, where banks can actually access short-term liquidity and then solve this problem. Solvency requires capital infusion, and that's why solvency problems are generally slightly harder to resolve. Now I said, so this is from a systems point of view. This is an outside in view of banking, that, you know, from outside, if you're an RBI, this is how you look at banking system. You're not looking at individual bank, you're looking at it as a system, and you are also looking at these two types of problem. For an individual bank, the risk universe consists of three risks. Credit risk. Credit risk fundamentally means counterparty default, which means that banks through their business have all manners of counterparties, right? You give loans to a borrower through a loan agreement, the borrower becomes a counterparty. The borrower has to pay you back. The borrower defaults, that's your credit risk. But it can even have in a derivative transaction. You have done a swap deal with somebody, that other counterparty default, that's also credit loss, right? And this is a default of counterparty that is not covered by collateral. Normally what happens, if somebody defaults and you have a collateral, you liquidate the collateral. Let's say loan against shares. You've given somebody loan, 50 rupee loan against a 100 rupee share. The person defaults, you liquidate the share and get the money. But if you don't have collateral, then this translates into losses. So that's what it becomes credit risk, which is what happened in case of NPAs.
So that's why these banks have that value at risk concept.
Correct. They have value at risk concept, they are loan to value, those kinds of metrics, right? And therefore, recovery and bankruptcy law becomes very important. Until 1960 to 2016, we did not have a bankruptcy law. So bankruptcy law kind of defines the rule. How do you recover in event of counterparty defaults? Then there is market risk. Market risk means that movement of any market determined variable, not just interest rate, but any variable, interest rate, exchange rate, that change and that adversely impact the bank. Now, there was a bank called Silicon Valley Bank in the US that collapsed. It collapsed entirely out of market risk. They were holding government bonds and the interest rate went dramatically up. So the value of those government bonds fell. It fell by 40%. So imagine in your entire book, you lost 40% value. So of course your capital got eroded. So it's one example where a bank went bankrupt, not because of credit default, not because some borrower did not fall, because the market value of your investments went down, right? And in India, you have to separate out this risk in interest rate is something called banking book and trading book. So even in RBI regulation, you will say interest rate risk in the banking book, IRR, BB, and interest rate risk in trading book, TB, and then the interest rate risk in the whole bank. That's how RBI also wants bank to assess them. And therefore, the two functions that manage this risk in a bank is called asset liability management and treasury risk management. They look at different aspects of this risk, but they are essentially managing market risk. And lastly, there is operational risk, which is risk of losses because of people, processes, and technology. Something breaks, somebody makes a mistake, theft happens, frauds happen. All of these are operational risks. And the way to deal with them is things like internal audit, statutory audit. This is what you guys do, which is there are God knows how many number of audits in a bank. I mean, I used to sit on audit committee one point of time. There are probably 30, 35 different types of audits, and yet things get through, which is one of the things that I wondered when the IndusInd episode happened. How did it get through so many levels of checks? They should have been concurrent audit, internal audit, stat audit, risk committee of the board, chief risk officer. I mean, it seemed to have escaped everybody. Sorry? Yeah.
And with so many big bombs doing the audits.
Okay. Yes. So that is about now the reason this is important, because entire risk management within financial institution focuses on these three risks. So everything that you look at in a financial institution is targeted towards managing these three types of risk. So also a regulation. RBI is extremely prescriptive in how do you deal with each of these risks. So they have detailed circular, master circular RBI is 580 pages. A lot of it is about this. I talked about connectedness of banks. The banks are very highly connected with each other. There are large number of transactions between banks. I mean, it's a dense network of interconnectedness. And as a result, what happens? They also do consortium lending. I'm going to go a little bit fast. Interconnections could also happen through NBFCs. Multiple banks lend to the same NBFCs. They have partnerships, similar AMCs and so on. If you RBI publishes every 6 months something called Financial Stability Report (FSR), and they in that report they put something called a network diagram. So they show a diagram of all financial entities in India connected with each other. It's a very nice diagram, and it shows how dense the connection is for banks among themselves and banks with NBFCs, banks with AMCs, banks with insurance companies, and so on and so forth. So it's a very highly interconnected system. And interconnection creates risk of contagion. Contagion means it's like a virus, like one person catches a virus, it can spread to other people. Similarly, one entity goes into trouble, it can spread to other through these connections. And that's the reason regulators are very concerned about. Now, good example of contagion was what happened in the global financial crisis. Few entities went into trouble, but it slowly spread to all of them, to a point where at a point it's appeared as if everybody will be in trouble, right? And therefore, regulator must monitor and control contagion risk. This is the reason why regulators focus so much on systemic risk. If you hear RBI, they will always talk about systemic risk. This is what they're trying to control. That one small entity going down somewhere should not create a system-wide disturbance. Yeah. It is important to create public faith. Remember, banking whole financial system work on the faith of people. All of us put deposits with banks because we have a faith in the system that it will remain stable. That maintenance of that public faith becomes very important. That's the primary role of the regulator. So they basically entire regulation is focused on actually containing this risk and risk of contagion, both in Indian in individual entities as well as in the system.
So that's why, in order to have the faith, RBI had a special category for the banks too big to fail.
They are called systemically important banks. There are 3 of them, and they are regulated even more tightly than other banks. So that's in a nutshell what happens. So with that background, now I'll move to how in a bank risk management actually happens, right? So there are 3 main elements in any financial institution of banks as in terms of how they manage risk. The first element is what is called risk policies. All banks have, all well-run banks and NBFCs will have set of risk policies. There are quite a number of them. There will be a credit risk policy, there will be a market risk policy, there will be an operational risk policy, there will be an IT risk policy, there will be information security risk policy. A lot of them are very, very detailed, and they are typically approved at the level of the board. And this is what, so that is the first component. The second component is what I call risk processing and MIs. There are certain kind of activities that get conducted every week, every month, every quarter, every year. There is a set of processes, they generate MIs, which is sent to a set of people who are constantly monitoring risk. So the second important component is to have right kind of risk processes and risk MIs. This is a business of information. If you don't know, you don't know. And so therefore MIs become supremely critical. Okay. So processes and MIs is some same component. And the third component is risk organization. There are a set of people who are actually tasked with managing risk. Their job, their daily job is to come to work and manage risk. They are not doing business. They are not raising deposits. They're not making loans. They are just managing risks, right? And underneath all of this is, they are all connected. By the way, policies describe what kind of organization you should have. They describe what kind of processes and vice versa. There is an iterative process in defining these 3. And underlying all of this is technology. Increasingly, a lot of these things happen over technology. So a lot of MIS comes out of technology. A lot of processes are embedded in the bank's technology. In fact, recently RBI brought in a circular saying that entire compliance, regulatory compliance has to be tech driven. There has to be a technology platform. You can't start saying manual returns and so on. So even the regulator insists that more and more of this happens through technology, right? Now, this is in a nutshell in any financial institution, how risk management happens. You will find these 3, as I said, in a well-run organization, these 3 things in place, supported by technology. Now, what do the risk policies mean? It means an overall guide to risk management. The policies embody what the attitude of that institution about risk is. And in fact, one of the things is that you do is something called risk appetite. RBI formally wants banks, for example, to declare what is called risk appetite statement, which basically says which risk I'll accept or not. So I'll say I'll not accept commodity price risk. So I'll never get into a business where I'm exposed to commodity prices. Or I'll put limit, my foreign exchange risk will not exceed XYZ, some percentage of my capital. So this risk appetite statement becomes quite important. And that's where a lot of the risk policies begin. These policies are targeted or specifically, so the bank will have a credit risk policy, a market risk policy, an operational risk policy, an IT risk policy, and so on and so forth. And they are generally approved by the board. I mean, regulators expect that they are to be approved by the board. These policies also create structure and processes and also empowerment. So, for example, the policies will say who in the bank is allowed to take what kind of risks. So it will define sanction power. A general manager can sanction loan up to X, then the committee of general managers Y, etc. All these, it's called often called delegation of authority. It is contained in the policy. Yeah, or there is a separate policy document called delegation of authority where all of that is oriented towards managing risk. It creates processes. So all the processes that we talked about are actually described that there will be a process of such and such, which will measure credit risk and so on. The policies also provide oversight, meaning that at the end of the year, the bank or the institution has to certify that they have even complied with all the policies. So it creates a bit of an oversight. And these policies are regulated, updated mandatorily once a year, but sometimes more often if the regulations change. So that's the nature of policies. In any good bank, you'll find anywhere between 20 to 30 policy documents related to risk. That number of, or maybe 15 to 20, I would say, of different policy documents that relate to different aspects of risk management. Then you have processes and MIs, which is specific activities that the bank will conduct in order to manage risk. It includes things like MI generation. So I chair the risk committee of Karuvasa Bank, and there are a standard set of MIs that comes to me every month, every quarter, and so on. But on top of that, I'll often ask them specific MIs. So I'll say, okay, give me a monthly tracker on our exposure to textile sector because I'm worried about that sector. Let's say this is an example. So every month, last week of the month, I'll get an MI saying we have so many accounts, so much is our rupees crores of exposure, so many accounts are standard, so many are SMA1, etc., etc. So that on a monthly basis, I'm tracking that one particular sector. So this is what I mean by MI. So there are all manners of such MIs. When the IndusInd episode happened, I made sure, which we anyways to do, that our whole derivative exposure is within limits and is being tracked, it's being valued properly. All of that as a one-time exercise I got done. So this is an example of MIs, because without this MIs, I will have no way of knowing, right? So MIs becomes quite important, and also compliance with policy and regulation. So the MIs also constantly has to ensure or to give me the comfort as a member of the board, we are complying with all our internal policies as well as regulations. These MIs also depends a lot on lot of analytical tools. You mentioned about value at risk. So we use something called RAROC model, which is risk-adjusted returns on capital model for valuing our loans. We do all manners of analytical tools in order to better understand this. The purpose of all these tools is I really want to understand my risk better so that I can manage it better. So a lot of use of these tools is part of this whole risk processes, right? And the final element is risk organization. Now, most banks will have a risk management department. There'll be a chief risk officer who's the single most senior person in charge of risk management. There's always be a risk management committee of the board. And then there will be, at the lower level, there are different committees of executives. So there'll be a market risk management committee chaired by the executive director, stuff like that. So there is a whole elaborate risk management organization, which then conducts these processes. And it reports to either the risk committee of the board or the CRO and a combination thereof. So these three elements together result in risks being managed in a bank and a financial institution. So if you went as a statutory auditor or as an internal auditor, these are the three things you essentially look at. Do they have policies? Do they have processes? Do they have organization? A gap in any one of them would result in a gap in risk management, which means that risks are not being managed properly. That's all the essential conclusion. Any questions before I move on? Okay. Now, just last two topics I'll take and then I'll stop. We are guided by something called Basel norms on banking, both for banking and NBFC and so on. I wanted to give a little bit of a historical context on when they came about. So in the 1970s, what happened was there is this committee set up called BCB, by Basel Committee on Banking Supervision, 1974. Now, 70s were a very peculiar era. Some of you might remember there was an oil shock. Globally, there were a lot of wars in the Middle East and so on. Oil prices quadrupled in 1 week. There was a lot of volatility. But this was also the time that international trade was growing very rapidly. And there were banks were getting internationalized. So a lot of banks were making overseas loans. They had global clients and so on and so forth. So on the one hand, there was a lot of volatility in the world. And on the other hand, banks were becoming international. So that's when people felt. Now, remember, you are a Japanese bank lending to a client in the US. Japan had a capital requirement of 3%. US had a capital requirement of 9%. They are not competitive because capital is very expensive. So that's where the realization came that you have to evolve global standards. You cannot have banks and financial institutions competing globally with very different rules. So that was the genesis of this committee. And this committee has been there from 1974. And they describe three pillars of how you banking regulators should regulate risk management in bank. This, by the way, came in 2004. Before that, it did not come. So this articulation of these three pillars happened in 2004. The first pillar is minimum capital requirement. Basically, what they say, look, any bank and financial institution should have minimum level of capital, because capital is your first line of, sorry, not first, but let's say the final line of defense against any losses, because owner's capital, right? And so therefore you have to have minimum level. It's almost like a fort need to having a minimum level of embankment, let's say, to protect it from enemies. So first pillar was minimum capital requirement. Second pillar was supervisory review process. So how does banking supervisor, i.e. RBI in India, how do they supervise banks? Because they have also a very critical role in making sure that banks are not taking excessive risk. And the third pillar was what is called market discipline, where they were saying that, look, insist that these institutions make public disclosures. And if they make public disclosures, the market will put discipline on them. If you are not disclosing a problem, your stock will fall. And this will discipline these institutions. So there is a lot of emphasis on what you should disclose and not. So these three pillars describe the Basel regime. There were three accords. First one came in 88, sorry, which did the first level of basic, very rudimentary minimum capital requirement at 8% and so on. The second one in 2004, which made it much more refined, which is where we are right now. We are largely under Basel II. And then the third one came in 2010, which is Basel III, which made it slightly more flexible. This was post GFC, so they started adding capital requirement for liquidity and market risk and so on and so forth. And Basel IV, which is still underway, which is not really a major change, which is just modification of the old one. They have put in some now capital requirement for operational risk and so on, even in India. Now you have to maintain some capital for operational risks and so on and so forth. But this is generally the evolution of the sort of Basel committee, whose norms still guide our own approach to risk management. So RBI by and large follows Basel recommendation in terms of way it looks at risk management. I will just skip this. This is just too technical. I had it. So, how do you actually define capital requirement for different? So essentially what you should notice here is that for every level type of risk, there's a way of measuring risk, which is what is called risk-weighted asset computation. So for every type of loan and all, you convert it into risk-weighted asset. And against that, there is a capital requirement. It's so for credit risk, for market risk, and operational risk. Together, that's the minimum capital banks have to hold, right? Huh. No, it's actually it's 9 plus 2.5. 9% is core, 2.5 is what we call counter-cyclical buffer. So it's effectively 11.5%. For NBFCs is 15%. But this 11.5 is not entirely equity. Minimum 8 has to be equity. Then there is tier 1 and tier 2 and all of that. 3.5 can be tier 1 and tier 2. So this is about credit risk. Capital adequacy, remember, this is all about solvency. And for liquidity, how does it manage? There are 7 liquidity ratios that RBI prescribes. I will not go into them. This is what every bank has to monitor. In my bank, I get another 4 ratios in addition to these 7 get monitored. There are this famous liquidity coverage ratio, which is a single ratio that RBI focuses a lot on, which looks at the liquidity condition of a bank. This gets monitored. And there's something called net stable funding ratio, which is really a measure of liquidity, which is how much is a stable funding in a bank and institution. What funding is unstable, which can go away in a week's time or a month's time. You have to have a minimum level of net stable funding. So you have to track these things very, very carefully in a bank. And I'll show you how it gets measured. And I will skip this. There is a reserve requirement also, which is SLR and CRR, which is also oriented towards maintaining liquidity in the bank. In general, liquidity is far more dangerous for banks than solvency. More banks have gotten, most banks have gotten into trouble because of liquidity problem, not because of solvency. It's actually very, solvency problems are harder and longer to solve, but they don't arise that quickly. Liquidity can really arise out of the blue. And that is why, as a general principle, when you audit a bank, you have to pay very good attention to liquidity conditions in a bank, because they can deteriorate very fast. And then when they deteriorate, there is not too many solutions that get left. This I'll skip. How do you price credit risk? And that's all. That's all I had to say. I've already taken more time, more than an hour. So if there are any final comments, questions, I'm happy to take them. Good. Thank you very much.
Thank you, Dr. Sir.
Thank you.
Formal vote of thanks. I request our deputy convener, Lalit Vardhan, to do formal vote of thanks.
Yeah, thank you.
Thank you, Dr. Harsh Vardhan, sir, for giving this complicated topic in such a nice and useful way. It was a really wonderful making us understand. Otherwise, this topic is a very, very complicated topic, but in such a short and sweet way, you have presented so, I mean, perfectly that everybody can gather some information. This what kind of market is, what kind of liquidity is in the bank. So thank you for this wonderful session.
जिनको भी गिफ्ट नहीं मिला है ग्राहकों का कृपया यहाँ से लेकर के जाएं।
I'm on the board of directors. Or but I don't have. I don't carry it. See you later. Can you take it from Thank you.
गोल्ड पिंच वाले लोग को बुलाई हूँ मैं।
हाँ।
एक फॉर्मल औपचारिक